Hey everyone, and today we are going to talk about two interesting companies that are quietly making big moves in their industries. So the first one is a digital tech company, and it kicked off FY26 with a bang. Revenue jumped 18.7% and EBITDA shot up nearly 48%. And the second company is a crane rental firm, and it's rising fast on the back of India's infra boom. Revenue soared 81.5% this quarter, boosted by 5 times jump in wind EPC projects and strong growth in rentals. So basically, both the companies are expanding steadily, one through digital automation, smart acquisitions, and global AI-led offerings, and the other one through infra-linked services, order book growth, and international expansion. So welcome to another episode of Noisemaker, where we keep things simple and talk about companies that may not always come in the spotlight, but have a strong potential for future. I am Saizal Agarwal, Equity Research Analyst at Desvelado Advisory, and today we'll be talking about these two companies that are making solid progress in their business, and if current trends continue, they might keep growing even further. But before that, let's have a quick look at the disclaimer. So any discussion, facts or writings provided here are for informational purposes only and do not constitute any buy or sell recommendation. So please conduct your own due diligence before making any investment decision. Now let's move to the first company, Datamatics Global Services Limited, which is a digital tech firm that's helping businesses automate, serve better, and compete smarter. Coming to Q1 FY26 numbers, revenue of the company stood at 467.6 crores, up by 18.7% year-on-year. But the real highlight was its profitability. EBITDA jumped 47.7% year-on-year, with margins expanding by over 319 basis points to 16.2%. And net profit came in at 50.4 crores, reflecting a 15.8% increase year-on-year. Now, a big reason for this performance, the full quarter contribution from TNQ Tech, which they acquired in December 2024, and that acquisition really accelerated growth in their digital operations segment, which grew by 55.1% year-on-year, and it also helped them expand their footprint in Europe and in education and publishing vertical. Now, margins also benefited from tight cost control, including a structured cost optimization program covering delivery, infra, and internal workflows. They are even reworking vendor contracts to boost margin by another 200 to 300 basis points over the next 12 to 18 months. And for FY26, the company has guided for revenue of 1,950 crores and expects EBITDA margin to improve by 150 to 200 basis points, aiming for a range of 17.7% to 18.2%. Now let's zoom out and look at FY26 as a whole, where the company's revenue grew 11.2% year-on-year. EBITDA came in at 229.3 crores compared to 244 crores in FY24, and margin dropped a bit to 13.3% due to higher costs earlier in the year. So now Nishant will be joining in to give us more information. So Nishant, given their international expansion, focus on BFSI and logistics, and aggressive investment into AI, what's your take on Datamatics' next leg of growth?
Great breakdown, Sejal. I think Datamatics is entering a high potential phase. Their strategy to go deeper into enterprise automation for US and European clients is smart, especially because AI adoption in this market is expected to grow at the rate of 30 plus percentage CAGR till 2030, and their focus on BFSI and logistics is even more interesting. These sectors are rip for automation, and large deals are very much on the table. The TNQ tech integration is just the start. If they can replicate that kind of synergy with other offerings, we are looking at sustained margin expansion. And then there is the R&D front. They are planning to invest 40 to 50 crore annually into AI-led research, including agentic AI, Gen AI integration, and domain-specific language models for BFSI and logistics. The idea is to build proprietary solutions, not just resell tech, but create IP that offers real differentiation. So, Cesar, with all this going on, how important do you think AI investments and IP creation will be for Datamatics' long-term positioning in the automation space?
That's the key point, Nishant, because in a commoditized services market, proprietary IP becomes the moat. And by investing in Gen AI, domain specific LLMs, and agentic AI, they are not just chasing buzzwords, they are really building assets that can support premium pricing and deepen the client engagement. Also, small language models for BFSI and logistics, they give them an edge, and these sectors need context rich, secure AI models. And if Datamatics nails that, they can become a preferred partner for large scale digital transformation. So, Nishant, I think my final question would be, with improving profitability, IP led growth, and global expansion, do you think Datamatics is shaping up to be the more than just another mid cap IT stock?
Yeah, absolutely. I think they are moving beyond the traditional services tech. If execution holds, we could see them evolve into a specialized enterprise automation player with a clear edge in AI-led solutions. So to sum up, Datamatics is delivering strong revenue and margin growth, benefiting from TNQ tech integration, running cost optimization programs with further margin potential, investing in Gen AI, agentic AI and domain focused models. Also, they are targeting BFSI and logistics in US and Europe high potential markets. So, if they execute on these fronts, Datamatics may well be on track to re-rate not just on earnings growth but on strategic relevance in the AI automation space.
Okay, thank you so much, Nishant. Now let's move to the second company, Sanghvi Motors. They are in the business of renting out medium to heavy duty cranes, catering to both private infrastructure players and government led projects, especially where large scale material handling is involved. So, in Q1 FY26, the company posted strong 81.5% year on year jump in revenue, reaching 273 crores. And this impressive growth was largely driven by a near 5 times surge in Wind EPC revenue, which touched 106 crores. And meanwhile, the core crane rental business stayed solid, contributing 160 crores, reflecting the benefit of past capacity additions and smoother project execution. Operating expenses did increase, mainly due to higher manpower and admin costs. But EBITDA still came in at 107 crores. Notably, the crane rental segment maintained a solid EBITDA margin of 56%, which helped to sustain overall profitability. And as a result, PAT grew by 24% year on year to 50 crores. And to support this momentum, the company also added 33 new cranes this quarter and announced a 300 plus crores capex plan for FY26. And they are entering the next few quarters with an order book of 767 crores, out of which 494 crores is yet to be executed, giving strong revenue visibility. But what's more interesting is that they have begun expanding into Saudi Arabia, settling up a local team, a strategic move that could mark their first serious international step. So, Nishant, with wind energy activity rising and global expansion underway, how do you think Sanghvi transformation is shaping up?
Yeah. Great context. I think Sangvi is going through a critical evolution phase. Traditionally known as a pure play crane rental company, they are now clearly building out a second leg through Wind EPC. States like Karnataka, Maharashtra, and Gujarat are seeing strong momentum in wind energy installations, and Sangvi is capturing that by bundling crane services and with EPC execution. This shift is important. It diversifies revenue, improves fleet utilization, and reduces cyclicality in earnings. So, and also on the global side, Saudi Arabia is a very strategic bet. The region has massive infra and oil and gas projects where crane rentals contracts are longer, better priced, and often USD denominated. Add to that relatively lower local competition, and Sangvi could end up commanding higher billing rates abroad than they do in India. So, Cecil, while their international plans are promising, how does the core financial performance look when we zoom out over the past year?
Good question, Nishant. If we look at FY25, the company clocked 782.1 crores in revenue, which is up by 26.5% year on year, and it was largely driven by second half acceleration. In fact, Q4 FY25 revenue was 267 crores, and they have already surpassed that in Q1 FY26, which speaks to strong execution. And EBITDA for FY25 came in at 371.1 crores, which is slightly down from 409.1 crores in FY24. And that brought EBITDA margins down to 45.1% from 63.3%, and which looks like normalization after an exceptionally strong FY24. Now, net profit for FY25 was standing at 156.5 crores compared to 187.9 crores the year before, with net margins easing to 19%. So, yes, there is margin compression, but top line growth and operational scale, they have still remained strong. So now, Nishant, with over 300 crores in planned capex and rising demand across both wind energy and infra, do you think that this capex cycle will pay off for the company?
Yeah, absolutely. I think this capex cycle is well aligned with industry tailwinds. By adding more cranes, they are strengthening the rental engine while also preparing for larger wind EPC contracts where equipment ownership gives them cost and execution control. More important, entering offshore markets like Saudi Arabia could act as a margin hedge. USD billing means currency linked income and longer tenure reduce downtime risk. If even 15 to 20% of revenue becomes export linked, that could support higher average realizations and margin stability going forward. So to wrap it up, Sanghvi Movers is transforming from a pure play crane rental firm into a more diversified future ready player. Strong revenue growth in Q1 FY26 led by Wind EPC. Then rupees 300 plus crore capex plan for the crane additions. Approximately 67 crore order book ensures near-term visibility. Expansion into Saudi Arabia brings pricing power and USD billing. Wind EPC on their end becoming a serious season growth engine. So if they execute well, both domestically and internationally, Sanghvi could re-rate as a premium infra logistic play with global exposure.
Okay, thanks a lot, Nishant. That really helped us to understand the direction both these companies are moving in. Now, let's take a look at some of our previous picks and see how they have performed. So first we have Yatharth Hospital and Trauma Care Services Limited. We picked this up at 630.1 and now it's at 704 rupees, giving a return of 11.7%. Quality Power Electrical Equipments Limited from 720.8 rupees to 744 and that's a gain of 3.2%. Bajel Projects Limited, it moved from 246.9 rupees to 244.9, delivering a slight minus 0.8% decline. Cartrade Tech Limited, we picked this up at 1698.6 and it's now at 2085 rupees, giving a return of 22.7%. And at the end, we have Garware Technical Fibers Limited. This one saw a dip from 912 to 855. There's a decline of 6.3%. So overall, a pretty good mix. And we'll continue to monitor all these companies closely to see how they shape up in the coming quarters.